Hello, it's John McLaughlin again. Welcome to another session. We're going to be trading gold on a strategy called the Crossfire strategy. This strategy is a really simple strategy, and if you're a beginner to trading gold, then this is always a good place to start. We've been trading this strategy now for over 2 months, and we've only lost 2 trades down to human error. So one time we were talking while we were teaching, and the other time was mine when I forgot to check the news, which was last week. Other than that, the strategy has performed, spotlessly in the time that we've been testing it, which has been over 60 days. So if you're watching this on YouTube, what I'm going to be doing as well to accompany this set of videos for the training videos is boiling things down a bit more, because in the sessions I talk about imbalance, I talk about moving averages, we talk about PSARs and stochastic indicators, all those tiny things that if you're not 100% sure about what they are can often make you a little bit confused sometimes. I always say we're not born with the abilities to trade the markets. We're not born knowing what a stochastic or a moving average is. So I'm going to be putting some smaller, more condensed video trainings together. And again, if you're watching this and that's the sort of thing that you want, then let me know. And don't forget to subscribe to the channel as well, because by subscribing to the channel it just gives me an indication that you're out there, you like the content, and I can keep producing the more content for you as well. So if you like the idea of not just trading gold and showing you the strategy, but also showing you how imbalance is formed, what imbalance is, what it means to see imbalance on the charts. I've been talking about consolidation. Now, a lot of people will say, look, there's consolidation. And in a group environment, people will say, oh, right. And a lot of people who don't know what it is won't shout up, and they don't really understand what consolidation is or what it means to be placing a trade. So they're the sort of little videos I'm going to be doing as well. So I'm really kind of looking forward to those. So if that's the sort of thing you want to see, drop me a like, drop me a comment, let me know, and let me know how I can help you, because that's what it's really all about. So yeah, as I said, it's a Monday. The markets are warming up. It's always interesting to find out what happens on a Monday, and particularly on a Friday as well. And if you've been watching the sessions, if you're watching this training, you'll know that Friday is really, it's fun. I love trading on the Friday. There's so much news about. There can be imbalance around. We can look at price action and how it operates and the volatility, and it's great to see and be able to read it and place our trades accordingly. Okay, so let's get started. Again, as I said, don't forget to subscribe to the channel, drop me a comment below, let me know what you want, and I can make that content for you. All right, let's get started. They say 90% of all success in trading is psychology. If you've lost trades by chasing trades, over-leveraging, or second-guessing your strategy, then you are acting from your emotional brain. The part of your brain called the monkey brain. It makes you act without thinking, and then calls you names for losing. Access my brand new resource, Teaching the Monkey to Trade. This training is designed to improve consistency and results, teaching you proven NLP techniques. You'll also get access to an exclusive interview with trader and master NLP practitioner about learning 90% of what it takes to succeed. Get free access to the resource and interview by clicking the direct link in the description below. All right, good afternoon, John McLaughlin here. It's the start of the trading week. It's the 20th of June and it's 1300. And we're about to do another session on the Crossfire Gold strategy. This is trading gold and obviously the US dollar. And let's just see what's going to happen for today. Last week was really good, apart from the day where I missed the news. Friday again was another good session. The market was quite volatile before it closed for the weekend, and again today, with it being Monday, probably will be, that's not really good English, is it? It possibly will be more volatile with it being Monday. So before we look at the charts, let's have a good look at the news. So going at my FX book /Forex economic calendar. This is where I like to get the news from. And we've got nothing really much on the horizon there. 58 minutes, you can see we've got Euro news, we've got GBP news, a little bit of USD on there at, in 3 hours. But all in all, considering last week was really busy with news, with USD, that's what we're looking for. Got USD in a day, doesn't make any difference. Tomorrow might be a little bit of tomorrow at 1500, but that's for tomorrow. We're not going to bother with that now. Okay, so nothing really to concern ourselves with. Let's have a look at the other one as well. Forex Factory. And again, Forex, it's always worth just checking both sets of news from the different feeds, but as you know, I always prefer the previous one, my FX book, 20th of the 6th. GBP, a little bit of USD on there, it says bank holiday. So it's saying the USD is on a bank holiday, is that right? Let's go and have a quick look at that. So it says the 19th, June the 19th was yesterday. Never bank holiday weekend, yeah. Okay. So if you're watching this in the US, apologies for my ignorance. Okay, so we've got, all right. So Monday the 20th is a federal holiday, Emancipation Day. All right. It's been about 20 years since I worked over in the US, worked over in Florida, had business over there, knew everything, and then as soon as you come back and you kind of close that door, you kind of forget, so apologies. So it is a bank holiday today in the US, which could affect the markets, it could make them a little bit lethargic. Let's go and see what the charts have done. So going back to just this is Friday, if you remember. This is where the news was on Friday. And we got a couple of nice moves. We've got the up move and we also got the down move on that for 40 pips of profit. That was nice. The other thing I want to look at as well is, remember that we drew these levels of imbalance on where the market had gone in one direction and it had gone for the buy in quite a severe direction above, and what you end up with is imbalance. So you end up with lots of money being paid out to sell for buys, okay, and it makes the markets imbalanced. So as I always like to say, it's a bit like, you know, when you with your household bills, let's say you're paying your milk bill or your newspaper bill, and you just keep paying out and paying out and paying out, and you go into negative. You go into drawdown or you go overdrawn. Okay, so there's an imbalance there. It needs to be corrected, and it's the same with the markets. And this is where we had the imbalance. So we drew a zone on here. Let me see if I can zoom in because that's too small. Let's stick it on there. Okay. So here was imbalance, and if you're not quite sure what imbalance is, I'm going to be doing those videos, I think this week. I think it's a good time to do it. Imbalance there, and no, there's no imbalance there. There's maybe a tiny bit. You see from that wick here down to the top of that wick there, and I'll circle it. No, I don't think there's any there. Nothing there. No, nothing there. I'm sure I saw some earlier, but maybe not. No, I think possibly it was it that I was looking at? Yeah, we got a little bit there, look. So, I'll do it on this side. So from that small wick, that little doji candle, okay, and it goes down to this wick on here. Okay, that there is that there imbalance. Style. We'll extend it right so we can see it. I think it's a little bit lower on this 5 minute. Yeah, look, it's right down there. It's right down there. So there's a big gap. So we've got this imbalance that we looked at. You see how it just wicked? It just wicked down, but didn't quite take all that imbalance out. And I said on Friday that the markets before the weekend may want to take out this imbalance and write that imbalance before the weekend. And it's still got a tiny bit from that wick down to there, and there's more here, and we've just identified a bit more here as well. Yeah, we're happy with that. You can see how price shot up, and if that candle there had gone down to here and then gone up, then that would have corrected this imbalance here from this fast move, but it didn't, because it was an indecision candle. It kind of went up and down, and it went, oh, I don't know what I'm doing. Ended up being a small volume, big wick, before then it moved to the upside. This imbalance, this candle is a bigger candle than this, but because the price came down to here, we could say technically, I want to get my finger on point, but let me just, I'll illustrate it on the with the circles. So I'm circling that wick there, and I'm circling this wick here. It's tiny, but you know what? I'm going to put it on because it is imbalanced nonetheless. All right, so from there to just there. So again, even if imbalance is just a line, and that is, it's kind of a bit of a thick line, but if it's a line, you can say there is imbalance at this price, and price can come down and touch it. Now, at some point, the market will have to take out that imbalance, but we don't know when. Okay. If we knew when, then we could just set our take profit and our stop loss and walk away, but we can't. But it gives us an idea. Okay. So there's the levels of imbalance. We've got our moving averages on the chart. So we've got the 5, which is the yellow. We've got the 13. Let me just zoom in a little bit. I'll zoom in on the 5 minute. And again, apologies for doing all this zooming around. I know it's a bit frustrating sometimes. Okay, so the yellow is the 5 minute. Okay, and this represents the last 5 moving candles based on the 5 minute time zone. Okay. So where was the price based on the last 5 candles? Well, it was the yellow line. Okay. This one here is the 13 moving average. So it's the average price based on the last 13 candles. And this moving average is tied in, or is configured to work with an indicator. So as you can see, it's red and green. So when the price goes up for a potential buy, then it goes green, and it goes red for a potential sell. All right, so that's the way that works. The next one above is the grey one, which is the 800 moving average, and when this is in the right position, it's sometimes good for a take profit. The 50 down here is the red one. The red one is the 50 moving average. The blue is the 200. All right, and again, any of these lines, usually the blue and the red, the 200 and sometimes the 800, can act as support and resistance. It can act as lines on the chart that where the price can either bounce or break, or even potential take profits, as we saw on Friday. That was a perfect example of how to set a take profit level. Even though we say go for 10 pips, when there's a clear path, then we take it. Okay, or we can lock profits in at 10 and go further up using different strategies that we use with Exit Manager. So currently the stochastic on the 5 minute is kind of 3/4 up. It's showing us that buyers are in control. There's quite a bit of a separation between buyers and sellers, as you can see, the blue and the red lines on the stochastic there. But everything else just seems to be, it's a little bit all over the place. Nothing really defined. What we want is those lines to be bunched up to give us a more accurate reading. So when they're all in the top for the extreme, we can sort of say to ourselves, maybe we're going to go in for a sell, and the likewise for a buy, the opposite for a buy. On the 15 minute, let's have a look at the stochastic for that. And again, very similar picture, kind of all over the place, nothing really defined. We've got the 15 minute down here. So it's showing us that buyers kind of in control. That little hand, the little line is starting to poke up. But at the moment, nothing really much doing, nothing really defined. So what we'll do, we'll go and put the, it's 13:12, I've been gassing a bit too long today. So we're going to put the box and the trend lines on the 15 minute indicator. So the box goes between 1300 and 1500. That's that there. Okay, and what I'm going to do, I'm going to click it for you, click away. I'm going to get rid of that extension lines. So all we've got is that. Okay, and we can see it quite clearly. We're going to put the trend lines on. Now we'll put one at the top. I'll put one at the bottom. I'll put it there. And we'll change the top one to green. So this is the 15 minute, and whatever we put on the 15 minute copies onto this other chart here, which is on the 5 minute currently. So this is our 1300 candle. Now when this candle is finished painting, it's going to move on to the next candle, and then we can start putting our trend lines on. So what we're looking for is, from this candle, we're looking for the higher high and the lowest low from this candle. Okay, so at the moment it's still painting, so it could change. But if you see that wick, it's just there. Okay, so the highest high currently is that green candle there, this one here. Okay, and that's where we'd then put this end of the trend line onto there. And the way we put it on, I'll put it on now, just to show you for illustration while I'm talking about it. We put the magnet tool on, and what the magnet tool then allows us to do is it just snaps. See how it snaps? Snaps onto there, nice and steady. If you don't put the magnet tool on, then you're kind of looking at it by eye, and you're wondering if it's on or not. So just get that's it, straight on. Okay, and from this candle here, okay, it's now 13:15, so that's good. So we're looking for the lower low from there. Okay, that looks, I think the red candle's a bit higher, so the green candle gets it, and then we're going to put the the green trend line goes on top of the wick, just as so, like that, and the red trend line goes on the bottom of this wick, like that. Okay, that's fairly. Okay, so that's on. So now what we do, we take the indicators, we take all our information from the 5 minute. So what we're waiting for now, we're waiting for the price to go above the green line for a buy, and we're waiting for price to go below the red line for a sell. And along the way, there are all sorts of different indicators and lines and things that are going to tell us, guide us, I will say, guide us as to what price is going to do. We don't know what price is going to do. We cannot define. Nobody can ever say price is going to do this or is going to do that. Price will do what it wants, and we have to read it accordingly based on what we've got. And what we've got is, we've got these lines, we've got our moving averages, we've got our parabolic SARs, which are parabolic stop and reverse zones, we've got our stochastic, and really for this strategy, all you really need is 2 lines. But I like the additional confirmation stacks, the additional probability stacks of the stochastic and the moving averages, and also the imbalance. I think for really the imbalance is one of the best things, because we know price has got to come back, but we don't know when. Okay, so let me just put a little line. Let me just see where that imbalance came down to. All right, it came down to there. So I'm going to put a horizontal ray on this 15-minute time zone, just there, because that's where price went to previously to take out some of this imbalance. So price came to there. So if price comes down to there, we don't want to get too excited. I mean, we could potentially get into a trade if the conditions are met. So what do we want for conditions to be met? Okay, so at the moment it's going up. All right. So number one, our indicator, the ninjacator, is showing us that there's a ninja up. Oh, actually, no, sorry, forget that. There's a ninja down there as well. That's a bit bigger, John, so you can see it. Okay, so what we need is for there to be a ninja up alert. Okay. At the moment, we're looking at the stochastic going up and into the extreme, which means potentially it's been overbought already and the price may want to come down. But remember that the stochastic is just a lagging indicator. It tells us what's happened. It's not a predictor. All right. We don't want to be taking trades anywhere in between here. Okay, we just want to ignore that. And also, if we got the indicator and price then went above that, what we've got above here, we've got this moving average. Okay, the 200 moving average, which can sometimes give us an idea of where price wants to go to. Now, price could shoot away from that, but it could also bounce. Okay, whenever there's a line, okay, price can either bounce off it or break. Okay, so initially what we're looking at is this is going to be a potential target. So if we measure this, let's say we've got some clear air above the green trend line. Up to there is only 11.6 pips. Now if that was 25 or 30 and price starts to go up, we might start getting a bit interested. But at the moment it's looking a little bit lackluster at the moment, so we just sit and wait. Okay, so look, there's a ninja up. Ninja up's kicked in, and remember that ninja up can get repainted at any time. It can disappear at any time. So just because you get ninja up alert doesn't mean you get excited and jump in the trade. We just sit and wait. We've got this distance between the candle, so the more, there we go, that's a bit more positive, but then again we've now got less distance between there and that moving average. So the price is in the extreme on the stochastic. Now what I'd be waiting for, we've got 4 minutes on this time frame, and what I would be waiting for is to see how price respects this moving average. It's going to do two things. As I said before, it's going to go up to it and bounce off, and what you can see there is that happening. It's just bouncing off that area, or it will break. So you imagine getting all excited, now you're in a trade, oh yeah, it's fantastic, it's going up, and then oh, it's come down again. What's happening? I've got the alerts, I've got everything's lining up, what's going on? And as you can see, one of the other things is respecting that line. So what's the overall opinion of the way the charts look right now? Well, it's Monday, there isn't any really significant news coming up. There's been a few pushes. So looking at the 15 minute, there's been a push early this morning, 0330, and there's been a push to the upside at 10 o'clock this morning, GMT. At the moment, the market is just consolidating, it's going sideways. And again, sometimes, you know, Monday, look, there's a big area here of consolidation. If I put my parallel line on, if that would, yeah, literally look where it's consolidated from. The green trend line. Where are we doing? Oh, we're on there. Take the magnet off. That's across to there. So pretty much that or thereabouts is, it could be an area of consolidation. Let's take it to there. It's a bit more interesting. Okay. So what do we know about consolidation? Well, what we know about consolidation is where banks look to accumulate liquidity to place their own orders. So let's say we've got buyers and sellers, all right? We can talk about this while we wait for the markets to do something. So we've got buyers and sellers in this little range here, and this range is, you've got 20 pips, let's say 20 pips. You've got a 20 pip range, you've got buyers and sellers in here. When you buy the market, you put your stop loss below, and when you sell the market, you put your stop loss up here. And what the big financial institutions do, the banks, the big pension funds, the banks certainly know where everyone's stop loss is, and they can go out and take people's stop loss out by forcing the price in whichever direction they want to. So let's say you've got buyers and they've got stop losses down here, they can force the price downwards to take out people's stop losses. So that gets rid of them, and that adds more volume and liquidity into the markets at that time. They can then push the price back up to then take out the sellers, take out their stop losses. So it takes all the retail traders out of the market, and they can then push the market wherever they want to go to place their own orders, because they've got the liquidity, they've got the money out the market, and they can then go and make their own profits. And remember that, for the markets to move 1 pip, on average takes $10 million. And if we're looking at moving this, let's take an earlier move. So here, a little bit of area of consolidation, price goes to the upside, takes everybody out, price then goes to the downside and takes everybody out that side as well. And that's what's happened. So just here, let me just show you that. So if we said there, obviously it's a little bit wiki, okay, so look, everyone's in here, let's push it up to the push the price up, that takes the sellers out, let's push it down, that takes the buyers out their stop loss. And that's the way it happens. And then here we've got another area of consolidation. So are we going to see another push in one direction or another? And usually you do, you just don't know when. So having identified this area of consolidation and knowing what consolidation means, we can then sit and wait for price action to come alive, and then we can identify what's going to happen. As you can see, look, this ninja alert, that's been taken out, that's disappeared now. The stochastic is kind of like all over the place, okay, it doesn't really know what it wants to do. The 5-minute time frame has kind of crossed over. It's telling us nothing's happening at the moment. So that buyers may be in control, but then sellers may be in control, crossing over, and all we do is wait. And the thing is, with a Monday, we just wait, and if we don't get a trade, then we don't get a trade. That's it. You can go on look at another strategy if you want to. You can maybe go and look at different indices. Maybe you can go and jump on to German 30 or whatever you do, as long as you've back tested it and you know what you're doing. Maybe you can go on to fiat currencies. But if you're learning, and if what you're learning is the Crossfire strategy, and you're happy with it and you're confident with it, and there's no trades, then close the book for today. There were no trades for today, and that's it. We'll come back tomorrow, and you can see what last week was like. Last week there was a trade every day. It was really buoyant. There was lots of volume in the market. It was fun. There was a lot of fun last week, and we did some pips as well. Okay, so more importantly, and of course, by rights, I can't talk about profits or percentages gained, because we're not permitted to do that as far as financial conduct goes. So I don't. And as well as I do, if you understand and if you study how the markets work and how percentage gains work, and if you understand the numbers, then you'll know exactly what we're doing, and that's what it's all about. But certainly, past performance, what happened last week, is no reflection of what's going to happen this week. We could have a really crap week this week. We just don't know. It's like you say, it's the US bank holiday. Is this reflecting the US bank holiday? I would say more than likely, because we come on the markets at 1 o'clock because it's the US Open, and because there's a lot more volatility and a lot more liquidity and volume in the markets, and today there just isn't. got some movement to the downside, as you can see. For that candle to be a trade worth taking, then what we'll have to do is have to wait until the candle goes down towards the parabolic SAR. It's got to touch the parabolic SAR, which is just past the red trend line. The PSAR will then flip, it'll go on top. We may get confirmation from the indicator that conditions have been met, and then we can look at the trade and see what it's going to do. But I always like to get the alert for the price to go in the direction of the trend more positively, a nice positive move, and then just wait to see what price does. So an indicator alert on the 5 minute is like an early warning system, and you've got to wait. An indicator on the 15-minute time frame is more of a confirmation of the price and more of a confirmation of potentially getting in the trade. So 5 minute is like an early warning system, and then we just wait and see what price action is going to do. So 2 minutes and 20 seconds left on the 5 minute time frame. It's 13:32. At the moment, it's all kind of quiet. When it's like this, just sometimes it's nice just to go back and check, make sure your box is in the right. But I've done this before. I put the box on, and sometimes I've put the trend lines in the wrong place, on the wrong candle, and it doesn't really make a massive difference. But it's always good to check. It's a bit like checking your handbrake and your gears. You know, when you're going down the road, just make sure I'm in the right gear and make sure the handbrake's off. That's always good. So looking at the charts at the moment, there's 3 minutes 40 left on this time frame. There's more likelihood of a potential buy than a sell, mainly because the PSAR is at the bottom. Excuse me. There is a fair amount of volume or distance between the PSAR and where this candle is right now. It's nearer to the green trend line, but as before, remember it went up there and then came back. Usually what you would see under normal conditions of price action on a Monday, or at least when the US is open, you would see more deflections off this moving average before it then went in the direction. You would see more deflections off there and then possibly a push to the upside. But at the moment, it sort of went all the way up there and then came back down and just went, nah. Okay. I think what's going to happen today with gold is it's just going to go sideways with maybe the odd push. Maybe one push where we've got the potential of making some pips, but maybe not much more than that today because of the US bank holiday. And again, without that information, without really knowing that it is a US bank holiday, we'd be looking at this chart going, what's happened to the markets? It's really quiet. Why, what's happening? What's going on? So you need to check the news all the time. There's a lot of traders, they only trade Tuesday to Thursday. That's their trading week. They don't trade Monday or Friday because of the potential volatility. What I like about the Monday, under normal circumstances on Friday, is that you can get lots of volatile price action. It is quite nice. So a little bit of move to the downside, but again, look, it's going for it and then it's coming back, and if you watch these sessions, when gold goes, it doesn't mess about, it just goes, and you get big massive volume being pushed in the matter of a few seconds sometimes, and you can see, I'm going to go and measure that, see what it is. It's probably going to be about 5 pips, 3.8. On balance, you're looking between sort of 30 or 40 million being pushed in. you know, in the big scheme of things, it's just pocket change. You know, when you think about the 6.6 trillion US dollars on average going through the forex markets a day, it's just an astonishing amount of numbers. So again, you know, if we're looking at this and we're going to go down for the sell, then remember, as I said before, it's got to go down, it's got to hit this PSAR, the PSAR's got to reverse. We then get an indicator alert, we then have to wait for it to go below the trend line, and then we have to see what price action is going to do before we even consider getting into a trade. So we don't get excited, we just wait. As soon as we get excited and emotions take over, we lose our emotional intelligence, and well, we don't have it to start with if we're getting excited, and we just start making mistakes. And then remember what I said about, you know, the instant gratification, your monkey brain wanting to take a trade. Now some people will be looking at this, kicking themselves because they didn't get in here, or kicking themselves because they didn't get in for this buy before it came down, you know. And a lot of people do that. Why didn't they get in? Should have gone into a trade, you lost out. And it's just purely their emotional brain, their chimp brain, or the monkey brain just telling you, give me some instant gratification. And what you've got to do, you've got to teach that monkey brain that it's okay to wait. And would you rather be out of a trade, wishing you got in, or in a trade, in drawdown, wishing you'd never got in and wishing you were out of it? And you don't want to be in that position. You don't want to be in a position where you're wishing you're out of it, because you look at the numbers going, go up, go up, go up. No, wrong way. Go up, go up. Oh, that's it, taking me out. You want to try and make trading, or you need to make trading as emotionless and as painless as possible. And just be a robot. Just look at the strategy, learn it, get educated with this sort of thing. And if you're not 100%, then take trades on a demo account. There's nothing wrong with that. But take them seriously on a demo account. Because, you know, one of the things you'll do on a demo account is that your monkey brain will be going, it's okay, I don't care. It's only pretend money. Doesn't really matter. And then as soon as you start, you know, a lot of people find as soon as they start using their own money on a live account, every penny in drawdown, it can be painful. It can be stressful. And, you know, I've heard of people saying they felt physically sick when they took a trade, hit that, felt physically sick because they were using their own money. But eventually it gets easier, it gets better, you cope with it. So again, markets just going sideways movement. And what I'll do with this session is I'll just cut it short at the top of the hour, and we'll come back and see what happens at the end of the session, if there's any more learning to be had. But looking at this, as I said, there's only going to be maybe one opportunity to look to take. I don't know. Nothing might happen. Nothing may happen until 1500. So what we'll do is have a quick look. This is a 5 minute. Let's go and have a look at the 3 minute. See what that's doing. That's going to be even more flat then, probably. So this is a 3 minute time frame. And this was that push earlier that came up and down almost in the same breath. Going sideways. Look at the 1 minute. What you'll see with the 1 minute, you'll see lots more. You'll see a quicker price action. You'll see it moving quickly. See down and up and down and up and down and up. And you can look at the 1 minute time frame. So 1, 2, 3, 4, 5. This is what we've been looking at. The average of these on the 5 minute time frame. So the average of these 3 candles on the 3 minute, no, those 3, sorry, that's 3, and so on and so on and so forth. But when we're looking at, we can look at the different time frames, and sometimes it's nice to get a confluence, which means they're all lining up the same, of the different time frames. So if we look at what we're on now, 1 minute, it's going up for a buy. If we look at the 3 minute, it's going up for a buy. If we look at the 5 minute, it's going up for a buy. If we look at the 15 minute on here, it's going up for a buy. So that gives us confluence about what's happening. But then what you want to be doing as you're looking at your trades is kind of flicking between the different time frames. And we've got the 5 and 15 minute permanently on our charts. But it's always good maybe to then flick back. What's happening in the 1 minute? Has it come back down? Okay, it's come back down a little bit more now, even further. Okay, and this is what's happening because the market's just consolidating. There's no volume in it at the minute. Let's go back on the 5 minute. So a nice positive candle in any direction is always identified sometimes because there would be no wick on the bottom or on the top. So if you look at a nice positive move, if you look at this one here, okay, it's got a tiny wick but a big body, okay. And for this session there aren't many. Smaller wick, but again nothing really significant. That's a bit more, look, nice big push up, nice big push all the way up to there. That gives us a nice indication that it's quite a decent bit of volume. So again, these are the little sort of nuances and that you look for, and these are the sort of things that you pick up. And as I always say, the most important thing you can do as a trader if you're learning is go and do back testing. Essentially just go back in time, pretend that, you know, back in time is today, do the trade as you would and see what happens and play it forward. I'll probably go through a bit of that. One of our live traders in the community, Richard, he went through a back testing strategy because again, I say to people, go back test, assuming everyone was born with the knowledge of what that means. So again, he did a video showing how to back test. It was a great video as always. But yeah, back testing your strategy and going over and placing as many trades as you can on a demo account. Sorry, this is my MT4. It's not connecting for some reason. Not as though it really matters at the moment. Might have to go and use a different broker. You know, it doesn't matter what indicators you've got on your chart. You can have the best indicators, you can have the best chart setup, you can have the best trader that ever lived, but if the price doesn't meet the conditions of your strategy for a buy or a sell, you don't take a trade. If you look at this, this is quite an interesting little observation on the 15-minute time frame. That you've got all the moving averages from the 5 to the 800, okay, almost converging in this little area here, okay. So where was the market? The last 5 candles, or it was just there, okay. That's where price was. Where was price at the last 800 candles? Well, it was just above it. It was just there, okay, just there. It's in that little area there. So it's a little bit different. There's a bit more separation on the 5 minute, but again, I don't really think we've got enough volume if we're going to go for the buy between there and up here. And as we saw here, it kind of went up and straight back down again, and it respected that line pretty much. But usually you see a nice big separation of the moving averages, and what you want is them set out in order. So you got your 5, your 13, your 50, your 200, your 800, and they all act or serve as, you know, points where the price can bounce or break, as we demonstrated on Friday. But at the moment, it's all together. The markets are, in fact, the markets look like they're closed. They look like they're closed. Right, 4 minutes left until the end of, until the top of the hour. And sometimes, you know, we're trading, it's like watching paint dry. And if you're someone that watches these sessions and you watch them all the way through, then you've got to be a good person to do that, because sometimes they are boring. It's good to learn, don't get me wrong, it's good to learn, but you know, when you sat there and you're kind of looking at the screen and you're looking at me and I'm looking at the screen looking at you waiting for the price to do something, you know. But this is how we learn, and let me tell you, what other things can you do where you can sit in front of a chart for 2 hours at maximum and potentially make your money for the day? So we might look at this and you might think, okay, well, there's a bit of volume starting to emerge. Maybe we're looking at a downsell. And then you look at the 15-minute and you realise actually there's no volume at all. It's just wiki candles. Okay, so these little doji candles, 5, 10, 15 minutes. Not much on here. You know, it just continues. So we've got 2 minutes left before the top of the hour. 41 seconds left on this particular time frame. Let's see what happens. Well, we're about to cut off because it was top of the hour, and the market just seems to have just had a sudden injection of liquidity somewhere, because it was going up. Now it's suddenly shot to the downside. So this must be manipulation from the UK side. And as you see, it's going. See how the markets have suddenly warmed up, and we're now literally top of the hour, 2 o'clock, and something is making those markets dance. We know it's got to be the financial institutions, because they're the only people with the liquidity to be able to do that. You see how it's just touching now the red line there. It's 50 moving average. And again, we know that prices are going to bounce or break from that area. So at the moment, see how it's just dancing around it. It's kind of bouncing up, then it's breaking back. Now it's going for it a bit more. But again, there's not a lot of volume in between the top of the trend line and that moving average. That blue moving average is 200. So we've got the PSAR below that candle, but you can see as it goes up, you've got the 50 moving average, the red line. Did it bounce or break? Okay, it broke away from that. Then it goes to the green trend line, okay, that we placed on earlier. That is going to be, like I said, an area of support or resistance. It's now, because it's going up, it's got to go through it. It's an area of resistance for it, and price will bounce or break from that area. And if it breaks away from it, we've only got, in fact, that moving average is coming down from here, so we've only got 8.6 pips. It's not even worth getting excited about. Yeah, possibly we could take 5 pips or 6 pips. Remember that our target is 10, and you know, our target was met this morning on the Crossfire strategy with GBP AUD. That was a nice little move, and that's our training done for the day. But here we are doing gold. Yeah, look, it's just bouncing back. It's just retracing, and again we're back to another indecision candle. Right, okay, I'm going to call it a day at that. For this, it's 3 minutes past the hour. It's 14:04. 4 minutes past the hour. It's always the case where I say, right, that's it, I'm going to go, and then the price suddenly wants to come alive a little bit. We'll come back at the end of the session. Okay, welcome back. It's 15:09. Let me just show you what happened during the course of the trade on the 5-minute time frame. So just before 1400, just before I signed off, the price went up to this 200 moving average, and this is where I thought price may well go to. And it's either going to bounce or break, and it bounced a couple of times, and then it broke to the upside. Before then coming down back to where it is now. And I didn't actually get in this trade. I didn't bother with it because number one, I was a little bit cautious about this moving average and the fact that there were only about, I think, 8 pips between the top of there. It's like 7.8, and then from above it to there was about 14 pips. But again, it was just one of those days where I thought it's a little bit choppy. There's not a huge amount of volume in the market. There was at this point, and of course there was at this point, but before then wasn't a huge amount. And of course we're looking at a classic case of consolidation. But for me, I'd already secured profits for the day. And really, if you're in a position where you're kind of going, well, it might go up, or it might come down, okay? Or I could put my roulette wheel on number 18 and hope it comes in. And at the end of the day, you're just gambling when you're doing that. So I didn't go in the trade. I didn't actually enter the trade. Didn't bother with it. And sometimes you look at it and you go, oh, I could get in the trade. If I'd have got in here, this is one of the things. If I'd have got in here, I could have stayed in. I could have made 24 pips. And if this, well, who cares? It doesn't matter at all. It doesn't matter what you do. In hindsight, it's what you do at the time that counts. And if your decision is to stay out of a trade because you're not 100%, then guess what? You're using the strategy to stay out of a trade. Okay. As far as the strategy goes, if we didn't have the moving averages on, let's take the moving averages off as a bit of a learning exercise. So take those off. Now look at it. So now we could say, okay, the ninja up happened here. So there's a ninja down going left. So conditions were met here. We could have got in the trade. I generally get in the trade about sort of 25% of the way into the candle. I don't get in straight away. I kind of wait and see what happens. So that would have been about there. So potentially, again, we would have made our 10 pips. We'd have made our 10 pips, but, I wasn't 100% about that. The next higher high from here is up there. And the next kind of spot on the sell side is below this line, which is the remainder of that imbalance. And then you've got imbalance further down as we discussed at the beginning. So profit secured for the day from the earlier Crossfire session, still secured for today, and we'll come back tomorrow when I think there's going to be a bit more action because the US markets will be open and gold will be reacting in a way that we're kind of familiar with. And that's another thing is when gold reacts and it's kind of the price action isn't quite familiar, and you'll know that from your back testing. You'll understand that it's maybe not a good time to get in the trade, and that's what we did today. All right, so that is the end of the session for today. So we're going to say no trades for today, nothing taken, and more importantly, nothing lost, and the account has been protected. Anyway, we'll see you on the next session. Bye for now.